Okay, so good morning, everyone, once again, and welcome to this Positivity and Robert Half Quarterly Economic Update, part of our Tackling Tomorrow Today series for 2022. My name's Paul Middleton, and I'm joined here today by my colleagues from Positivity and our sister company, Robert Half. It's great to see you all here, and especially to see some familiar names and faces. Today, we are talking about the future of our UK economy and our global economy. Last time, we spoke with John, it was back in March when UK inflation was forecasted to be just over 7% and UK growth was estimated to be just under 4%. It seems like a lot of change in the last 3 months since we last met with John, and economic doom and gloom seems to be never far from the headlines. So what does the future hold for us? Can we expect some better news? What's going to happen to oil prices, fuel prices, gas prices, grain prices, interest rates? And what effects the war in the Ukraine going to have? How will the biggest Fed rise in interest rates since 1994 affect the global economy? And are we tumbling inevitably into a UK recession? So we'll be exploring what that means for us day to day and what that means to our businesses we work in, what that means to our markets and our pension pots as well. So to answer all these questions and to unpack all this, and more importantly, to answer all of your questions, I'm delighted to welcome back Dr. John Ashcroft. As some of you may remember from John's previous appearances on our collaboration forum and previous quarterly economic updates, John specialises in economics, strategy and financial markets, working with professional firms, large corporates and small medium enterprises. John is the author of the Saturday Economist, his weekly blog published on a website of the same name that some of you may subscribe to, discussing the UK and the world economy. And my team will post a link to John's website in the chat. So John specialises in environmental modelling, and it's this combination of modelling and statistical fueled economics that has resonated with so many of you before. So we thought since March now, it's time to bring John back and to give us an update, and a particularly timely one, as I said, off the back of some of the Fed interest rate rises we've seen. John will be presenting his thoughts using some slides. So if you have some questions or comments, please put them while he's presenting in the Teams chat bar as we go. And we'll take it from there. Now, we'll be equally at the end of this conversation. If you want to ask John questions, please just come off mute or stick your hand up. But the key thing is for you to get involved. This is your session, and so the more we hear your voices, the more we have your interaction, the more you will get out of it. John will probably speak for around 40 minutes, so we'll have plenty of time after that for questions. But whatever you do, as I say, please get involved, as it's infectious and this is your forum, and so you can direct it where you wish it to go. So John, great to see you again. Thank you for joining us, and over to you.
You are. You can have a shower.
John, we can't hear you.
Well, the best way to get up and wake up is have a shower, have some breakfast, darling.
John, we can't hear you. You're on mute. No, you're on mute again, John. Let's sorry, everyone. Just bear with us while we resolve these technical difficulties. John, is it worth you trying to log? I don't know if you can hear us, but is it worth you trying to log back in, see if that works? Okay. All right. Well, apologies for the delay, everyone. While John does that, we'll wait here, and we'll soon, hopefully, soon be back online. As I say, thank you all for joining us on this. This is part of a regular forum that we have, a regular quarterly economic update. As I say, we thought it was very timely to have this now, just given everything that's been happening in the markets and obviously all the economic headlines that we're seeing. So I can't build this up too much because I guess I'm hoping that John's going to be able to join with it and we'll be able to hear him. Gary, there we go, he's back. Hello, John. Can you hear us?
How's that?
Excellent, John. We can hear you. I was worrying I was
Cool.
going to have to sing a song there or something like that to keep people entertained, but we're good.
No, that's fine. Okay, I'm not going to share my slide deck then, that's right.
Yeah, go for it, John.
Okay. Sorry about that technical. Okay, how's that?
That's all good, John. Over to you.
Okay, cool. Okay, so as Paul was saying, we're going to look at the world outlook this morning and also look at the UK outlook and also have a look at a market summary because it's quite interesting, especially with the Fed move yesterday, which had the markets in a bit of a flap on Monday when word was leaked out that there could be a 75 basis point move. So generally, yeah, the world outlook, UK outlook, market summary, and the labour market mix. And we talk about a global recession, big question mark, not yet, but brace for higher prices, lower growth, and higher rates. And the good news is we're leaving planet ZERP. We've been talking about this for a long time now, but planet ZERP, the world of zero interest rates, it looks like we're definitely on the move. But this is bringing it about. This is what we call normalization. 2 years ago, in 2019, in fact, I was calling for a worldwide moratorium for higher rates in the world, and what we're seeing is a reset. So near real panic, but the markets are panicking. So Wall Street stocks in bear territory, it says, amid fears of inflation. The European Central Bank is panicking and announced an emergency meeting to discuss the market route this week. Europe is prepping for a trade war no one wants because of Boris Johnson's manoeuvres in Northern Ireland. Weak UK pay and jobs figures hint at tougher times ahead, said The Guardian this week. Actually, there was nothing in the Labour figures to cause any alarm, but it was just the way the market reacted. Business confidence tumbles to a one-year low as the CBI and the Chamber of Commerce push for action from government on taxes, especially the corporation tax next year. So the CBI is warning on household spending with the big income squeeze for households, and there are growing fears about inflation, putting pressure on central banks, and US inflation, as we know, has hit 8.6. That's a 40-year high. So investors have spooked, and they're selling sterling, and sterling was trading at 121 just under yesterday. And of course, if you're into crypto, then the music has definitely stopped, to take the words out of that great US film. And the Fed yesterday, the Fed hiked its benchmark rate by 75 basis points. The Jerome Powell is determined to stamp out inflation. So this is George Soros setting the mood in Davos in March.
Thank you all for coming. Since the last Davos meeting, the course of history has changed dramatically. Russia invaded Ukraine. That has shaken Europe to its core. The European Union had been established to prevent such a thing from happening. Even when the fighting stopped, as it eventually must, the situation will never revert to what it was before. The invasion may have been the beginning of the Third World War, and our civilization may not survive it. And that's the subject I will discuss today.
Well, it's good they could laugh about it, really. So it's the beginning of the Third World War and the end of civilization as we know it. What he was talking about there was the suspension of the move to reduce global warming. So central bankers are getting hit and criticized for missing the inflation message. This is poor old Janet Yellen putting on the coals.
Certainly, as the president says, inflation is the #1 domestic economic problem facing the United States right now. But it wasn't just the president who got it wrong a year or so ago. I want to play for you what you said about inflation last year. Listen to this.
Is there a risk of inflation? I think there's a small risk, and I think it's manageable. I don't anticipate that inflation is going to be a problem, but it is something that we're watching very carefully.
Yeah, good to know they're watching it very carefully. So poor old Janet Yellen getting a haul there. So what we've seen is this pandemic shock in the first round, then the economic shock that came with that, the seismic shock as demand recovered, but supply didn't get quite in place. This is our graphic from last year when we talked about this disruption between supply and demand. We had the first inflation shock when the prices were escalating as a result of the bounce back, and then the shock of war. Then comes the second inflation shock. And we see the invasion of Ukraine, which is causing great problems, obviously for the Ukrainian people, but having a significant impact on price levels around the world. Putting Putin in perspective, it is important. We talked about this in March, that he is involved in a bear hug. Russia outside the top 10 in terms of GDP, and in terms of military spending compared to NATO, it is being outspent by a ratio of 20-1, with 50 billion to spend in Russia and over $1 trillion to spend across NATO countries. But nevertheless, this squeeze is leading to pressure with oil, gas, and grain. And we talked about global conflict and global tensions as part of our wall of worry all through last year. When we look at international conflict, as if that wasn't bad enough, we've got the problems in the South China Sea and China now threatening to close the Taiwan Strait. Good luck with that one. So moving on to the world forecast, we saw in the latest forecast in January, the IMF were forecasting growth of 4.4% for the world economy this year. By April, it had reduced to 3.6%. They're not due to forecast till next month, but it looks as if it could be down to 3% or even less. Nevertheless, this is where the OECD are, 3% this year and maybe 3% plus next year. Maybe a slight downgrade possible. But when we look at it country by country, there's a lot of information which will be up on the website if you want to check it all out when we look at the forecasts around the world, both for this year and the next. Kristalina Georgieva warned of lower growth and higher inflation, and so it is. The impact of inflation on stuff like nickel, coal, wheat, corn, platinum, and so on, these are real problems, compounded by the fact that Russia and Ukraine account for 30% of wheat exports and 15% of corn imports. And we see the problems now with the sunflower seed oil, with fertilizers, India threatening to banning exports of grain, Malaysia not sending any chickens to Singapore because they're worried about output capacity as a result of the fertilizer crisis. So the IMF boss has warned over food prices and has warned persistently about the real problems in Africa with the problems of hunger. And word from some of the emergency regimes, they're no longer providing food to the hungry, it's being diverted to the starving, which is a shocking condemnation of what is happening in the Black Sea at the moment. When we look at oil prices, oil prices have been trading at $120 a barrel. Lots of forecasts to look at. Bottom right, you see that Goldman's are calling for 140 to 130 in Q3 and Q4, with Morgan Stanley at 130 to 120, and Citibank about $99 to $85. We think, nevertheless, if it's a call that especially with the Fed announcement yesterday, that oil prices would come off the peak and start to trade lower. We see it in gas peaking again as Russia squeezes Europe, and also with grain prices, and also with metals, copper prices, and so on. The general view is that the worst will ease, the year-on-year increases will ease into the second half. So here's
look at energy, when you look at food prices, you rightly pointed out too, they're at elevated levels. Does it get worse from here? Can we start to see a peak? When do you expect things to peak out?
I think it gets better from here if you're looking at things on a period-on-period measure. There
you go. You heard it from the man himself. It gets better from here. But nevertheless, trade disruptions do continue, especially with continued shutdowns in Shanghai in China. And the good news is there's been some alleviation of shipping costs, where they've come off the top from August last year, now trading just above $10,000 to get a container from Asia to North America. Also good news on world trade. Big bounce back last year, 11% in 2021, and we expect world trade to grow by about 5% plus this year, given the strength of world growth overall. So this is not a recessionary scenario. Obviously, wobbles about China. This is where China stands in terms of the world economy, second largest after the US. But China growth this year was expected to be about 4.5%. By May, It had been downgraded to about 4.4%. JP Morgan have it in at 3.7 and UBS at 3. But generally, this is Bank of America.
And saying that the GDP economic growth was likely to fall short of its target. What is your forecast for China's economic growth this year?
We currently forecast a 4.2% for our baseline case scenario, but we have admitted that there are increasingly more downside risk to this number, and therefore we have already been.
Yeah, so we're hearing a lot of the possible downside problems in China, but it's important to see through the noise, a lot of noise in terms of the press and the reporting coming out of China at the moment. But it will overtake the US as the largest economy probably by 2030, maybe a bit later now, and it's going to double in size still by 2035. And the Asia-Pacific region is so significant for world activity that it dominates, bigger than the USA, North America, and bigger than EU, as we've always said. And this swing will move out of the dollar, despite the dollar strength at the moment. This is Geeta Gopinath. I'm not going to.
If you asked me today about does this imply the imminent demise of the dollar, I would say flat out no.
Yeah, certainly not. But what we will see is a swing away from the dollar dominance in terms of world activity over the medium term. Then we look at what's happening in the USA. This is Jerome Powell. Yeah, he always does.
I want to begin by acknowledging
I'm not actually pulling his clips from last night yet, but nevertheless, this is what we're seeing in terms of the downgrades that are happening. So where we were talking about 3.5% growth in the US in 2022 and 2.4% next year, the Fed now has slashed their forecast to 1.7% this year and 1.7% next, and thereafter a sort of steady state at 1.8%. And in terms of unemployment, well, they're talking about unemployment averaging about 4% running out now compared to the earlier estimates of 3.7. So, and in terms of inflation, the inflation rates reckoned to be it was 8.6% in April. It's reckoned to ease towards the end of the year, and the Fed have it down to 2.6% by 2023 and just over 2% in 2024. Will that happen? Well, we'll see exactly what's happened to the inflation levels. Producer prices, if you're an optimist, you might say they're easing off the top. In terms of consumer prices, well, again, they're wobbling about just over 8% at the moment. The big thing is the big change in monetary policy, because this was the blue dot forecast in last time the Fed met, but now the forecasts have been hiked up much more significantly, as we will see. So the trend rate is reckoned to be over 3.5% now for the Fed funds rate compared to 2.5% last time. And the fundamentals will still, in the medium term, undermine the dollar. So we see these forecast deficits from the Congressional Budget Office, the internal deficit, the spending deficit, and also the trade deficit, which, despite tariffs, is increasing. And of course, we've got this massive debt of about 30.5 trillion. Here's a fun chart. It's the US debt clock, which is ticking away. And if you like that one, then there's also the world debt clock, where you can look at what's happening around the world in terms of debt accumulation. So America, the Fed has moved. They're going to slash down on inflation. They've bounced rates by 75 basis points. Next time it could be 50 or maybe even another 7.5. They're forecasting rates to bounce to 3.5% by the end of the year. So what are the EU? If we look at the EU, again, it's a similar story. They're slashing their forecasts of growth from 4.5% this year to just under 3%, 2.8% and 2.1% next year. The inflation rate expected to behave peaking at 7%, falling to 3.5%. And this is how the monthly data looks. So when we look at these forecasts, they're being slashed at the moment, and they could continue to be slashed. The important thing is when we look at what is happening to monetary policy. This is our forward guidance chart, which we started to do every Friday. But in the USA, you will see that in 2022, the rate of 2.5% was expected this year. The Fed are now saying it's going to be 3.4%, rising to 3.75% next year. And in the UK, we expect the Bank of England to move by maybe 25 basis points today. But nevertheless, we're thinking that the rates could go from 2%, which we thought by the end of the year, to maybe as high as 2.5%. And the euro also will be forced to move. So lower growth, higher inflation, rising rates, and we've seen bond yields bounce accordingly. So bond yields nearly 3.5% in the US and 2.5% in the UK. When we look at the forecast for the UK, then again, it's a question of, okay, in Q1, there was nothing in the April forecast that suggests there's a problem as yet. Growth was up nearly 4% year on year. And in the first quarter, growth was up by 8% year on year. Last year's figures were so bad. So generally, analysts are expecting growth of 3.5% to 4% this year. The big question is what's going to happen next year, because the 2.5% is beginning to look a little bit optimistic. The OECD caused a stare when they said there'd be no growth next year at all. So the forecast scenarios, quite honestly, we're not quite sure at the moment what is going to happen. This year, growth may fade into the second half as a result of the consumer squeeze, but a lot of manoeuvring because of the tax rises to come. That's the trend rate of 4. When we look at inflation, then inflation is reckoned to peak about 10% through this year, towards the end of the year, according to the Bank of England. And thereafter, forecasts are expected that inflation will fall towards some semblance of normality, but still not achieving the 2% target. And of course, when we look at, this is the Bank of England forecast by quarter, when they run out. So if you can wait long enough, by 2024, everything's back to normal and it all looks hunky-dory. When we look at the oil impact, this is what we reckon in terms of the oil impact. The impact of trading at $115 a barrel through Q2 means that the year-on-year rate of change is 70%, but by the end of the year, it actually falls to, so by the time you get to Q1 next year, the rate of change means that oil prices are falling year on year, even though they may remain just under $100 a barrel. And this is why it's assumed that prices will ease as we get into the second half of the year. In terms of the labour market, the conundrum of the labour market persists. The latest unemployment figures, again, it was suggesting unemployment was rising. It was a modest rise, actually more people in work compared to the prior month. The rate ticked up to 3.8%, but there was still 1.3 million vacancies in the economy, which we'll look at in a moment, and 1.3 million unemployed. And here we're modelling at unemployment of about 1.4 million through the end of the year and into next year. But it's a very confusing picture, and also vacancies. So if there's a squeeze in the economy, then it's probable this squeeze will have a greater impact on the level of vacancies rather than directly on the level of unemployment, which is a positive thing. And when we look at this extraordinary ratio of unemployment to vacancies, then you can see more or less where we're at on that point. And when we come to the vacancies by sector, then you can still see health and social with 215,000 vacancies, and accommodation and food with 174,000 vacancies, and retail at 161. So it's still a very buoyant jobs market, even though there may be a threat to consumer spending because of the so-called income squeeze. And again, as inflation falls, then we reckon that the earnings figures will fall accordingly as well when we look at the trend rate of forecast. So lower growth, especially in the second half into next year, higher inflation moderated by Bank of England rate rises, unemployment figures, maybe we'll see a squeeze on the level of vacancies rather than the output level of the absolute level of unemployment, and earnings will moderate, maybe, but the bank really fears that that could kick off in a big way. And when we look at the level of unemployment, then, you know, there's this anomaly that we've lost 400,000 people from the workforce. Some have gone back to Europe. Some would have us believe that they're all suffering from long COVID, on long-term sick. And some would say that people are just reluctant, especially over 50s, to get back involved with the workforce. The spending review, we saw what is happening to government policy on spending and tax and spending is anybody's guess. We had the fuel duty kicker, which did nothing to ease the prices at the pumps. We had the national insurance claim, and we had the promise of an income tax cut to come. But then we saw the windfall tax. We don't call it a windfall tax. We call it a temporary targeted energy profits levy. Not quite as snappy, but it probably covers the point, really. So, and then we had the energy support measures being swept in. All of these measures are just knee-jerk reactions to and soundbite reactions to problems that may be emerging on a day-to-day, week-to-week basis, which is quite concerning. And certainly what we now see is the promise of, you know, Singapore or Britain as the Singapore of Europe is just a fantasy island.
The party opposite, we have a plan. A plan that reforms and improves public services.
Yeah, well, it's clearly evident that there's not much of a plan at the moment. The latest borrowing figures suggest that the borrowing activity will come down to below $100 billion this year, compared to the high of 320 billion a couple of years ago and 145 billion last year. So generally, there is scope to do something. What we don't really want to see is, you know, we don't really want to see the national insurance tax charges going up. We don't want to see the corporation tax levy going up from 19% to 25%. This seems quite bizarre, notwithstanding the level of public sector debt. We didn't talk much about trade. Well, we do, but the trade picture will continue to deteriorate, especially the trade in goods situation, and despite the surplus, continuing trade in services. But generally, you know, we still have this, as with the US, what we call the twin deficit dilemma: deficit domestically with spending and deficit externally in terms of the trade relations. Quick look at what's happening between the EU and the non-EU. Basically, we traded one deficit for another, that actually the deficit with the EU has fallen, but the deficit with the rest of the world has increased. And imports from the rest of the world have increased as imports from the EU have just stabilized. And no significant kicker, despite the strength of world trade, no significant kicker in terms of UK export performance. Sad to say, yeah, well, we did say this could happen, and it did. So here you've got the forward interest rate curve. Generally, brace yourselves because the base rates are moving higher, and we reckon that what we're seeing in the in a moment, what we're seeing in the bond markets is just a normalization. You know, inflation target 2.5% to 2.5%. Base rates should be around 4%, and 10-year gilts should be around 4.5%. And anything moving towards that is a process of normalization. It could be painful, but not as painful as it was in the 70s when interest rates averaged over 10% for 20 years. I just want to look at markets now because there's been a lot of talk about what happened in the markets. This is how we saw the markets in January. And this is published from the from the stuff we were doing through the year. That in January we were saying that the Dow, S&P, and Nasdaq were overvalued by over 20%. We look at 9 markets, so 3 in the US, 3 in Europe, and 3 in Southeast Asia. So what happened since then is the American markets have plummeted by 17, 21, and 34%, respectively, Dow, S&P, and Nasdaq. So it's a return to normality, and we've seen the reaction in Europe, specifically to the war in Ukraine, and also the reaction in China. And when we look at markets now, then we think the markets are reflecting more of a fair value. I am not licensed for investment advice, and we're not suggesting everybody should dash in there now any more than should pile into Bitcoin at $20,000. But generally, the Nasdaq is looking particularly oversold, and S&P and Dow look fair value, which is why the markets reacted in the way they did this week on Monday. A bit of an overreaction to the Fed news of a 75 basis point rise, but generally, you know, Europe, France, and Germany looking a bit oversold, and in Southeast Asia, if you've got the bottle to make the move, then there's some attractive options there. It would appear, but this is not licensed for investment advice. So all the panic about markets, bond markets collapsing, it's a normalization of the yield curve, what's happening to markets, overvaluation, overextension in January, and now we see a market correction. And talking about overreactions, then we know the pound is trading at 121 at the moment, and actually 104 against the euro, trading 104 against the dollar. So they're looking particularly oversold at the moment, and the medium position for the for the pound, or rather for the dollar, would suggest that we are moving into oversold territory. But then you heard it first from me. So when you look at the 10-year gilts trading at 341, actually softening a bit this morning. So they were down about 331, the 10-year bond market, and the UK down a bit from 241 maybe. But we expect the exchange rates to bounce back quite significantly. So lower growth, higher inflation, higher rates, commodity prices easing maybe, but still problems in oil and gas in Europe and grain prices. So global recession, not yet ready to make the call, but certainly we're in for a period of higher prices, lower growth and higher rates, and a bit of market turbulence along the way.
Thank you, John.
So that's a wrap. Let me kick out of this.
No, that's great. Look, thank you so much for that. You covered, as ever, an awful lot of ground there. Higher interest rates, lower growth, higher inflation, lower vacancies, earnings being moderated, and markets looking oversold for the bold investors. But so, I mean, John, you've got a wide range of people on this call. If you were sat in front of any one of them, let's say you were leading their business, with such a wide range of variables that you've covered, what would be the top 3 points that you would be advising them to focus on at the minute and to address?
Well, that's a good question actually. But I was talking when I've been offline for a bit, but I was posting last week on oil prices, and one of my regulars came back and said, in our business, we're importing wood from Russia, aluminium from Ukraine, and foam products from Germany. So in that scenario, then you're really struggling to so I think it's a question of going back to basics. You really have to focus on cash and the implications of interest rate rises as they're going to happen. You've got to do your scenario evaluation in terms of the growth patterns that could occur. Make sure you've got your labor recruitment strategies in place. And of course, everybody's dealing with the sort of just-in-time jitters, which is moving to more of a just-in-case provision. So no end to globalization, but maybe just an extension of working capital. So I think it's a question of understanding that what we're going through is a period of really normalization. We're leaving Planet ZERP. We wanted to get out of Planet ZERP. We hope that the Fed won't change its mind. We hope that the ECB won't panic too much about what's happening in Italy at the moment. But it's a question of, back to basics as always. And for a lot of people, it's just a question of grappling through these incredible supply side difficulties.
Absolutely. And I mean, that links quite well into a question, was the flip side that asked by Louise. For companies working with lots of suppliers and with saving commitments made to customers, do you have any ideas on how best to mitigate that risk going forward then?
Well, again, it's a question of doing the full risk analysis and understanding the prospects for radical change in supply rates at the moment are going to be so limited because of the problems that we're seeing. And we don't know, when the next issue is coming up. So we've seen this extraordinary, the lumber crisis has eased in the US, but now we've just had a baby food crisis in America. We don't know when the next crisis is going to occur for whatever reason, because some of the supply side issues have been stretched so thin. So it's a question of working with suppliers to try to understand demand patterns and supply patterns. And some of this stuff, it's just got to work its way out of the system, but it has been so extraordinarily difficult. It's a question of really working those supply chains and making sure that you've got good links in place.
So as it works its way, and Louise, thank you for that question on there. And I was just going to say, please, please do continue to put your questions in the chat or put your hand up, and we'll tend to John. But you mentioned kind of going back to normal, whatever that is, and Haynes asked a question: do you expect that we'll be reverting back to the world of Planet ZERP from 2024 onwards? With for the rest of the decade?
No, I think, well, it's difficult to say with confidence how the central bankers are going to behave. But if they can get out of, if they can leave planet ZERP, if they can establish, the Fed now are talking about the long-term rate being about 3.5% for the Fed's rate. Last time they were saying it was 2.5%, and again we were saying then it was too low. Really, the long-term rate for base rate should be around 3.5% to 4%, really 4% plus. The good news is for business, that what nobody's really talking about is as the gilt yields rise, it's reckoned that every 100 basis point rise reduces pension fund deficits by 20%. So what we've seen already is potentially a 40% reduction in the pension fund deficits. And when we examine the prospect of returning to normality, we would say, then it means that a lot of the pension fund deficits could evaporate almost completely. How about that? That's quite amazing. But if the central banks can establish a buffer, then it means they're better placed to be able to cope. The big panic was, big concern was, if rates are on the floor, what happens with the next crisis? Where do you go? Because QE is completely exhausted in terms of intellectual credibility, and the world of negative rates, well, we don't want to go there. So I think if central bankers can get off the floor and get airborne away from ZERP, then they'll be happy to stay circulating at high altitude for some time to come.
Wonderful, and thank you, Ian, for that question there. But I mean, that links very well into one asked by Afi. I mean, just to what you were saying then, John. I mean, how far do you think the Fed and Bank of England and other central banks will go to address those inflationary pressures? How far do you think they should go, and how far do you think they will go while we try and avoid that recession?
Well, the interesting thing is in the 70s, when inflation peaked at 25%, in the first round, base rates went to just over 6%, and it wasn't enough. So when the base rates rose again, they had to go higher, and over the period, inflation averaged 10% and base rates averaged 10%. So it's difficult to see, unless inflation does really start to kick down and quickly towards 5% by the end of the year, that really, from a Fed perspective, even a 3.5% won't hold it. But they're only releasing it at a steady state. They're only releasing so much information at a steady state because they don't want to panic the markets and consumers too much. So the Fed are determined to do it, and hopefully we'll see some of these price anomalies drift out of the market without rates having to rise too much and too soon. So
do you think we could be heading back towards what we saw in the 70s, or are the fundamentals different?
No, that's a great question, because what we saw in the leading up to the 70s was we had the extraordinary barber boom. When I started work in 1970, and I think I moved to my international job in 74. But we had the barber boom when growth in one quarter in 73 was 10%. That's real growth of 10%. It was an extraordinary boom, which led to the collapse. Then you had the Peruvian anchovy crop, which collapsed. We put pressure on the fertilizer prices. Yes, that is important. And then, of course, with a quadrupling of oil prices. So I don't think we're quite there yet. I don't think we'll get there at all. The comparisons with the 70s are just not appropriate. But we've got to cope with what is happening now. So I think, yeah, it's a process of normalization and escape from planet ZERP. And we've got to get this pressure on inflation to bear to bring it within semblance of normality, and soon.
But you think, and kind of linked, thank you for that. And, so linking to a question to Christina then, I mean, do you think that your prediction for interest rates in the long run is we're going to see kind of 3.5%, 4%? Are high interest rates going to stay for the foreseeable?
Well, the question is do you consider 3.5% to be high, given since 2008? Yeah, we think it is high, but actually it's returning normality to the yield curve and to the real level of interest rates. So, if you miss a price in capital in a capitalist economy, then you're going to have certain anomalies, which is higher asset prices that we've seen, both for equities and also for housing and property markets. So, yeah, 3.5% is the Fed call for the long run rate at the moment. And let's just feed on that for the moment, because that's up from 2.5% and it could drift even higher. Be interesting to see today what the Bank of England decides to do, because they're still more dovish compared to the very aggressive Fed move. It's interesting where they are. The Fed now very aggressive, ECB still very nervous, and the Bank of England not quite sure where they should be just at the moment.
Absolutely. Just maybe shifting on a bit there. I mean, so Rupert asked the question, the recent book from Irving King suggests that we're living in an age of radical uncertainty. Do you think, John, there's a need for businessmen or business people, rather, policymakers, economists, to build new ways of looking at the horizon scanning to understand the complexity of these risks?
Well, I think that it's the same stuff, really. You've got to have your scenario planning and looking at the different scenarios that we've got. So there are enough permutations in terms of the growth options into next year. At the moment, it's looking like there could be lower growth with some easing of vacancies in the labour market, but generally the same rules apply. You've got to look at the possible scenarios that could be invoked and model and plan accordingly. And at the moment, supply side logistics are critical to understand the way forward. And of course, it's you're moving with in a what can I say, in a sort of vacuum for government policy. We've had Build Back Better, that didn't last very long, and now we're levelling up. That's not going to last much longer either, I would think. It's a question of what the next. Now we're going to war with Northern Ireland, over the EU of Northern Ireland. Not quite sure what to do that now. I mean, and equally we're packing people off to Rwanda. But there's anyway, I digressed. But yeah, it's back to the same issue. Understand the prospects, look at the scenarios, and plan and model accordingly.
Yeah, I mean, certainly the horizon scanning is always a theme that we look at from a resilience perspective and other things like that. So I do agree. The boldness in that horizon scanning is critical because there are a lot of different factors at play. And we'll come to Brexit in a minute, I'm sure, and let you dig into that and give your views on that. But you're talking about the kind of, the different levers that, the governments can apply. Links into a question from Ramsey, with food prices increasing, fuel prices getting higher, mortgage payments going up, etc. What levers do the national governments have, given really, we're still recovering from COVID? I mean, you've spoken about Sunak's kind of $1 trillion banknote before, but what other levers are there, and what should we be expecting in terms of government intervention?
Well, I think if you look at the measures that could be used, basically it can happen through spending or taxation, the two obvious scenarios. If you look at the taxation scenario, you've still got this, for example, with petrol prices, this enormous tax take on with VAT and fuel duty, that actually some larger accommodation can be made other than the 5p off with 100 quid to fill a tank at the moment. Then almost half of that is going to government, and so there should be some big swallow on that. But we also, I mean, obviously the option on VAT adjustments to try and bring the high level of inflation down. Biden's doing his best to persuade the Saudis to pump more oil, and actually he's trying to persuade his own distributors and extractors to produce more output in the US. But going back from a UK government point of view, then really something could be done on fuel duty and some manipulation of maybe VAT rates. But generally, for a lot of people, it's going to be taking the hit over the short term, and hopefully, with the right policies from central bank, then we can bring the level of inflation down, maybe towards the end of the year, but certainly into next year.
So you're not expecting headline intervention, big bold intervention, mate.
Well, the problem is, I mean, Boris Johnson is saying one thing, and then the Treasury is saying something else. The grapple. I mean, why on earth we're raising corporation tax from 19%? I mean, 20% is a good level, but why hike it to 25%, given all the promises that were made? Why are you sort of increasing national insurance allowances and at the same time increasing the punitive rates for national insurance? So, in that sense, you'd like to see 20% corporation tax, maybe a 50% top take for income tax and national insurance combined, but there's no strategy at the moment, and there's no sense of see-through on it whatsoever, which is a really concerning matter.
So that's interesting, because that links into a couple of politically charged questions from Sukhdev and Tim around where you see your thoughts around our current leaders' ability to move from knee-jerk reactions to a more considered, structured approach, and what you would advise there. but also maybe, from Tim as well, just thinking, well, if the commentators are right and seeing a new UK Prime Minister this autumn, do you think there'll be a significant shift in fiscal economic policy, particularly if Sunak was no longer Chancellor as well? What are your thoughts around that, around kind of what that considered approach should be and what some political change could cause?
Well, again, I think businesses, CBI and the Chamber of Commerce and Business IOD, they're all calling for the same thing, some consistent policy. So you've had this flip-flop on, with a potential another flip-flop on corporation tax. They obviously always want more on investment allowances. They don't like to see national insurance charges, but it's difficult to see that any change in the behavioural patterns for the Prime Minister at the moment, and it's difficult to see this sort of consolidation or agreement between number 10 and number 11 changing anytime soon. So I think that's quite worrying, really. I can't see any change to that whatsoever. And I go back to the point, that we seem to be picking fights at the moment over the wrong issues when the big problems are going to have to be faced for the UK economy.
So if you were their economic advisor, John, you're sat down with them in a quiet room, what would you be saying to them?
I don't envisage I would ever be in that situation whatsoever. It's just, no, I'm going to dodge that one.
Yeah. Okay, fair enough. Brexit then, John. You haven't mentioned Brexit so far. We see a lot of noise at the minute around the impact of the Northern Ireland Protocol on our economic and other things as well. I mean, what's your reading now of the current and maybe trajectory kind of impact of Brexit on our UK economic outlook?
I think talking to businesses who are directly involved in it, then they perceive the situation is getting worse from a sort of relationship between the EU and the UK. So it's exemplified by the fact that Jaguar maybe are talking about taking their electric vehicles to Europe, and also the fact that businesses in Europe are recognizing that the UK is just not going to be part of the forward planning. It's a problem with things like the Horizon education spending program, that basically Britain is going to be isolated out of that. So anything there's a hardening of attitude that really there's almost like the difficulties of dealing with Britain are becoming too intense, and the problems of isolation could get even worse. So I think that we're not seeing any pickup in export activity to the UK or to EU or rest of the world at the moment anyway. But what we're seeing is the sort of level of even the level of imports in from the EU is losing place to the rest of the world, and it just doesn't make sense. So the fear is it's just going to get more difficult and with greater passport controls, greater paperwork at point of entry, and it's going to be more of a problem, not less of a problem.
Okay,
but fortunately we have a Minister for Brexit Opportunities, so I'm sure. In fact, a friend of mine who was doing a presentation to German businesses saying we can identify 3 clear advantages of Brexit. 1, we have blue passports, again. 2, we can now trade in in imperial weights. And 3, we can see the return of the pint pot stamped with the crown. And after that, he was stumped for additional benefits to move on, especially, and he was involved in chemicals, which is a big problem for the chemical industry.
Well, no, I mean, look, I'll be fascinated to hear other people's views on that. Again, just please put your questions in the chat or raise your hand and we'll come to you. Northern Ireland Protocol, John, I mean, is that just going to be a little bit of noise for the UK? Is that going to have any lasting impact, or should we expect more there? Well,
the Northern Ireland, it's like they used to talk about buying a dodgy car, a Monday morning car in the 50s and 60s, that if you bought a car built on a Monday, you'd be set with problems. Northern Ireland, it's like buying a dodgy Rubik's Cube, that will never be fit into, all the colours are never going to drop into place. So it really is so difficult to find a solution to the Northern Ireland question. And why? I mean, Boris, the government's breaking an agreement which it made with itself, in effect, and there's Davis suggesting that the problem is it's not a true Brexit, it's a Remainers Brexit that we've got with this deal in Northern Ireland. So, I don't see the solution to the issue, and I think challenging the EU at the moment is not the right way forward. But it's just very, very difficult.
Okay, no, thank you. John, just going to move on to another question from Afi. Just kind of looking at some of the impacts on the sanctions we've got in place with Russia. If sanctions were to be easing on Iran, and given what a significant oil producer that is, do you see that having a positive impact on fuel prices as we wind down our purchase of Russian oil and gas? Is that something we should be considering?
I think the big question is how far will, two things really, is how far will OPEC step up to increase output? And it's always said that the cost of extraction is extraordinarily low, but they weren't really, they're happy to see higher prices as long as it doesn't lead to lower demand or demand destruction. So the question is, which is why Biden's spending so much time in Saudi maybe, but is what's going to happen to OPEC output and what will happen to US output? That we haven't talked about ESG, but there's a lot of ESG pressure on US producers.
Yeah.
And at the same time, Biden's urging them to sort of become more aggressive in terms of output. So the big swingers to output is going to be OPEC and America, and we've yet to see what will happen. So the interesting thing is, if the demand swings out of Europe to China and India, then actually that means there'll be less coming bought from America and OPEC. So the thing should level itself out in reality, because there's no real switch to demand or supply in the medium term. So what you're seeing is a big speculative spike with a lot of profiteering at the moment. So I think bigger output swings from OPEC and from the US, and also some normalization once Europe or Russia stops putting a lot of pressure on gas deliveries into the EU.
You see it more linked to OPEC policy rather than opening up new countries like Iran.
Yeah, because they've got, it's like the wells are there ready to pump, and they're not pumping because they just want to they like the prices.
Yeah, no, understood. Okay, so John, you mentioned ESG. We've talked.
I thought I mentioned it before you did. Actually, that was all.
No, it's still. Don't worry, you haven't managed to veer away from this one yet. So I mean, ESG is an increasingly important topic with all of our clients here at Profitability and Robert Half. Do you think that these forces, and including the surge we see in oil prices that you just mentioned, do you think that should be accelerating the ESG agenda, and do you see any signs that's driving towards a green economy?
Well, yeah, I think we touched on this when we prepped, didn't we? But I mean, S&G should always be there as constants. They've always been there as constants in terms of governance and social behaviour and inclusion and so on. So S&G should be a constant. And what we're seeing is, which is what George Soros was driving at, really. His concern was the pressure may ease because of the popularity of fossil fuels in the short term. So the pressure may ease on the real climate agenda, which is the threat to civilization, not the Russian march into Europe. But his fear was that this sort of easing of pressure on fossil fuels could compound the problems for global warming. And I think that, okay, we're trying to solve a short-term solution, get a short-term solution to the problem in the immediate term, but the pressure continues and has to continue into alternative energies. And if anything, higher prices will make that prospect of move to alternative energies easier. So we know we've got real limitations and geopolitical complications with oil and gas that should accelerate the plans for alternative fuels, alternative energy sources, and also the move to EV, because the move to electric vehicles is really strong and swinging, with a near collapse in diesel pricing, diesel cars and petrol fuel cars. That actually those are really positive steps forward with battery technology and so on. So yeah, short-term hiccup, but the pressure has to continue. But we also have to be careful about greenwashing. Here's a new word we've discovered in the last couple of months. The prospect of, imagine that, bankers washing products to make them more fit for market. Terrible, but there you go. So yeah, ESG, terribly important. Short-term hiccup maybe, but the pressure has to continue, which is the point George Soros was making right at the start.
Okay. two more questions, then, John, we can probably squeeze in. What do you think, if we were to see a continuation of the conflict in the Ukraine, what do you think the lasting damage and the kind of economic impact of that is likely to be? Where do you see that, if that continues for the foreseeable months? Where do you see some of those fundamentals you've been mentioning will be most impacted, like price of grain, oil? What do you anticipate?
Well, the big issue is in the oil and gas. First of all, oil. More stability may return to the oil market faster than the gas market at the moment, but the real challenge is agricultural products out of Ukraine, because in a scenario where the stabilization, Russia made a big move into Crimea in 2014. Big move into eastern Ukraine in 2022. They may pause a bit, and may have to pause a bit. But the real threat would be if the squeeze on output via Odessa into the Black Sea continues, and grain products are deprived from the rest of the world. But again, that could be a 1 year issue or a 2 year issue. So I think, it's a tragedy of incredible dimension, and it's set the pattern for geopolitical challenges for years ahead.
Yeah, so John, let's, as always, it's good to finish this with a dose of your optimism. So, where is there opportunity? Where are you optimistic in terms of where we're heading from an economic perspective? What soothing words would you leave us with on this Thursday morning?
Well, I would say the interest rate changes are a return to normalization, and in that we will find positives, that common sense is returning to the yield curve. Good news for pension fund deficits, and I think that also there's so many new exciting technologies that are coming on stream, especially in terms of alternative energy and electric vehicles and so on. So we've got to make sure that we're well positioned to take to profit from those in the UK. And in that sense, we need a very proactive central government with a sensible policy and approach to domestic and business taxation.
John, we've run out of time, but look, as ever, thank you so much. To everyone here, thank you all so much for your questions and your input. Really, really appreciate it. If you've liked what you've heard today, please feel free to contact us at Protiviti and Robert Half. I'm sorry if I didn't get to your question, but please put them in the chat or contact me directly, the Protiviti team, the Robert Half team, or even John directly, and you'll see his details on LinkedIn and on the Saturday Economist website. There'll be a video of our forum today posted on our website, so please share that with your colleagues, your friends, and your LinkedIn contacts. So until next time, on behalf of all my Protiviti and Robert Half team, I'd once again like to thank John, and I'd like to thank you all and extend our best wishes to you all. Stay safe, be bold, be kind to each other, and we look forward to seeing you all again very soon. Thank you, everyone.
Thanks, Paul.
Thank you.